Meta, the holding company of Facebook, just reported earnings and the stock got destroyed on the news. Revenue is expected to grow only 3 to 11% year over year in the next quarter, signaling that the best days for the company might have passed. In this video, we will examine whether the reactions were justified, and we will model Meta's future free cash flow growth to determine whether this is a buy opportunity or whether the stock is overpriced. Welcome back to the Modern Investing channel, and let's dive into it. Meta, the company that owns Facebook, primarily makes money by selling advertisement space on its various social media platforms. The company's sites and apps include social media networks like Facebook, photo and video sharing app Instagram, and messaging apps like Messenger and WhatsApp. Meta also provides an ecosystem that allows users to connect through its virtual reality products, which in the last quarter became a new reportable segment by itself called Facebook Reality Labs. The last earnings report showed that Meta is at a pivotal point in its history. Meta has become hands down the leader in social apps, but in the past year, growth has been slowing down to single-digit growth. Especially Facebook experienced only a 5% growth in daily active users in the past year and 4% in monthly active users. This is far away from the stellar numbers that they used to report. But it makes sense, they got so big that there is simply not that many more people in the world to reach. At the end of 2021, the Facebook app reached a staggering 2.91 billion monthly active users. So at this point, the only way to achieve high growth is to increase the monetization per user. The good news is that they are indeed achieving that. Revenue jumped 37% year over year and net income jumped 35% in the same period. These solid numbers are great. However, without much growth to be expected in number of users, monetization will only be able to grow in the short term, and this is worrisome to many investors. That is why Meta is now fully committed to creating metaverse products and services, which is the Reality Labs branch. The management sees it as the only way to keep growth in the medium to long term. The problem, though, is that it is going to be very costly, and the CFO announced that the total expenses in 2022 are going to jump to $90 to $95 billion, and the capital expenses to $29 to $34 billion in the same period. To determine how much this actually is in the big picture and how much it will affect margins going forward, let's first review the past 10 years' financial results. Revenue, net income and cash flow from operations grew at a staggering pace in the last decade, showing a fast-growing and profitable business at the same time. Property, plant and equipment, which is the capital expenditure, also grew, although at a lower rate than the net income and profits. Free cash flow grew amazingly over the years and jumped to $39 billion in the last year. Share outstanding increased up to 2017, for then starting to decline thanks to buyback programs. Given the huge pile of free cash flow that the business generates, this is only expected to increase, and it is the way that Meta rewards its shareholders. If we move on the margins, they are absolutely staggering, with 80% gross margins and higher than 30% profit margins and free cash flow margins. There is really nothing to complain here. Full credit to the management team to print such amazing financial numbers. So the past is amazing. What worries investors is the future. Therefore, I made some back-of-the-napkin calculations to predict how profitable will be in the future. As we saw a minute ago, the CFO announced that spending is going to increase in 2022 to around $92 billion. It is an increase of 30% from the year before. At the same time, however, revenues are increasing at a slower pace, only 15% as per analyst estimates, and you can expect that this is therefore going to hurt operating margins. I calculate the expected operating income to be around $42.5 billion in 2022, and that would be a worrying decrease of 9% as compared to 2021. This is not good to see. Furthermore, if we make the assumption that operating cash flows are going to grow at the same proportion as operating income, which is a very rough assumption, we get only approximately $52.5 billion in operating cash flows. Remove the capital expenditure, which the CFO announced to be around $31.5 billion, which is a lot, by the way, a 70% jump from 2021, we get a free cash flow of only $21 billion in the next year. This is very worrying because it is a sharp 46% decline from the last period. And this is what the market is pricing in. a sharp decrease in free cash flow going forward as a combination of slower revenue growth, increased operating expenses, and increased capital expenditures. This, you can say, is the cost of the metaverse transition. Okay, based on these numbers, we have a 15.5% free cash flow margins for 2022. Let's now move on to predict the following years. I put here in red the analyst estimates for 2022 and 2023 revenue growth. For the years following that, I predict that revenue growth will slow down progressively to 5% in 2031. There are two reasons why I see this negative outlook. One is that we are indeed already seeing revenue slow down, and as of now, I don't see any reason for a reversal of this trend. And number two is that the metaverse transition, which is supposed to replenish revenue growth, is impossible to estimate, both in timing and size of revenues. Therefore, I choose to essentially ignore it and keep the estimates on the bearish side. So I expect the revenues to only almost triple in the course of the next 10 years. Regarding free cash flow margins, we have calculated that it will be around 15.5% in 2022, which is much lower than the long-term average for the business. I expect that they will keep low for a while, through the next 5 years, and that is because the metaverse transition will be very costly. Afterwards, I expect them to come back and increase gradually from 2027 and reach 25% in 2031. Overall, I would judge this prediction to be quite bearish for the business, and that is because the company is going to go through a turnaround. In this row, there are the future free cash flow that we predict by multiplying the revenue by the free cash flow margin. And over here, there is a graphical representation of the future free cash flows. From the year 2022 in blue, we can see that it will take 5 years to reach back to the 2021 levels. Let's now move on to the discounted cash flow valuation. In green, we have the free cash flow reported for 2021, and in this row, we have the predicted free cash flow for the years until 2031 that we took from the previous table. In the row below are the discounted values, and as you can see in this cell, I choose 8.6% and as the discount rate. This is the weighted average cost of capital, and if you are curious of how I calculate it, you can stop the video over here. Next, I calculated two types of terminal values in year 2031, and then I took the average of the two. The first method is the exit multiple. So I looked at the historical price to free cash flow of the business since 2013, and as you can see, it has been volatile, in general on a downtrending slope. As I expect the business growth to slow down, I expect the margins to decrease as well. So I took the assumption that in 2031 margins will be lower than what they are today and what they have been in the past. So I chose 17x as the multiple free cash flow. I put 17 in this cell here. The other terminal value is based on the perpetual growth model, which I chose to use a 2% perpetual growth rate. In this cell, we have the sum of the future free cash flows, together with the average of the terminal values. Here, we have it corrected for current assets and total liabilities, and here we have it divided by the share outstanding, giving us an intrinsic value of the stock of $309 per share, which is above what is trading now by about 30%, suggesting that the stock is undervalued. This is quite surprising to see because I chose the growth values, margins and multiples on the bearish side, and still the stock is undervalued. So what I see here as the positive is that this is an established business with an amazing balance sheet producing billions of free cash flow every year. I also like the mindset of the management team. They are not standing on their hands, but rather they keep on innovating and are committed to be at the forefront of the metaverse transition. I also like the valuation. I kept my discounted cash flow valuation with bearish estimates, essentially predicting that we will not see any substantial contribution from the Reality Labs part of the business anytime soon. And yet, I get the stock intrinsic value to be around $309 per share. On the negative, Apple has changed the privacy policy of its iOS devices, which make it more difficult for Facebook and Instagram to deliver target advertisement to Meta's customers. This is expected to cost Meta $10 billion in revenues for 2022. And this shows how much the business is at the mercy of third parties to collect data for their advertisement business. How much revenues will be impacted in the long term and whether Android will do the same thing is something that remains to be seen. Also, as we have seen, revenue growth and profitability has been predicted to sharply decrease in the coming future, changing Meta from a hyper-growth company to a growth company. Moreover, there is a lot of uncertainty around the business, and Wall Street hates uncertainty. Is this slowing down in revenue growth that we have seen in the last year here to stay, or perhaps even accelerating? Nobody knows for certain. However, it does seem that the long-term trend of high growth for the company has been broken. They are advertising the turnaround of the business with Reality Labs, but we shall see in the future whether it will turn out to be successful, when, and to what degree. What I think is that Reality Labs doesn't have to change the world for Meta to turn out to be fine. The way I see it is that it is more an optionality on the upside. If you like the free cash flow that the core business will generate, then that is all it matters. I see too much noise around this stock for the metaverse story and too little focus on the actual core business itself. In conclusion, I see this stock as the stable core advertisement cash cow business of Facebook and Instagram, and then the Reality Lab as an optionality on the upside. The balance sheet is amazing. I like the valuation, and I think that this stock will be irrationally beaten down in the short to medium term due to the uncertainty around the turnaround of the company. This could open up some juicy buy opportunity going forward. I don't own any shares yet, but I will be looking into adding if the stock gets beaten down further to some irrationally low levels. That's it for today. I hope you got value out of this video, and let me know in the comments what you think of Facebook as a stock to own at these levels. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.